Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending February 19th, 2016. What I've got on the screen here is the E-mini S&P 500 futures. And I just wanted to show you guys a couple of things here and what we can possibly expect. You can see over here we had a little bit of a double bottom. We had a test here. And in the center here, we kind of moved up. Couldn't really get a lot of, couldn't escape gravity, and we rolled right back over again, just like that. And then we actually took it out, and then we moved right back up into this area here. So it was almost, the measuring objective was almost very similar to this piece right here. Almost, but not quite. And then we had a failure at the double top up here. We almost took out our prior highs made in 2015, and then we just had this rounded roll off to the bottom here. So now we're looking at this pattern right here, and are we going to repeat this pattern right here? That would be, I think, what's on everybody's mind right now. So if we look at this and we take a look at the pattern here, you can see here, if I just kind of highlight it a little bit stronger here, this is a little bit more pronounced than the other pattern here. But if I come up like that, you can see that in this instance right here, we've kind of formed a W. And typically when we have this kind of pattern here, and we come up and we hit this area here, it does not necessarily, I mean, don't jump to the conclusion that, the measuring objective from here to here, if we just put it up here, it takes us right back up here again, right up to this 2080 area, which is right in that area there. That's what the measuring objective would suggest. I think this time is a little bit different, but this second test down here, we had the bullish divergence, and obviously I was getting all of our members ready for a nice run up to this area here, right around the 1940. In fact, that's what our measuring objective was when we started this movement right here, right back up. So we had a nice run, and now we find ourselves just slightly off of the highs here, with a little bit of a pullback on Thursday and Friday, relatively flat. Both Thursday and Friday, we're kind of digesting this move that we made here that took us right back up to the peak here, giving us this form of a W. Now, as we look at this pattern here, I do believe we're going to have some chop. The momentum, we had a close on Thursday and Friday that wasn't necessarily bearish. It more of digesting the move on this last leg of this W here. Should we break it? Should we break this area and start to move up? Our next really big area of resistance is going to be right in this area right here, as I just highlight it like that. You can see that it really provided a lot of resistance there and support here through the latter half of 2015 until we finally broke right here, going into December, January. Actually, January, we really started the year off at the high point. So we're still way underwater here. So if we can break this 1940 area and hold it, then I think the odds do favor us running back up very quickly to this resistance area here, which is a psychological barrier of right around 2000. And then we can probably look for another retest back down to the 1940 area before we decide, are we going to break this and come back down into this chop down here, or are we going to move back up here? Now, let me just clear the screen for a second, and I'm going to just put in a couple of key levels here. So again, my screen is just going to go all out in here, but you can see right in this area here, let me just highlight it with a little shaded zone here so you can see what I'm talking about. So that's one area that we've got to overcome. And then obviously, you can see this is an area here. These are two areas that we're kind of sandwiched in, that we need to overcome these areas here. So obviously, in this area here, right at that point right there, is right at about 1940 on the futures. It's a little bit higher on the SPX, the cash index, but that's the area where we've got to crunch our way through. Then I think we're going to be in kind of a tight pattern between these two resistance points, and then we're either going to break it to the upside, and if we do break it to the upside, we'll probably come back down and retest to confirm the break. And if it's a valid break, then we'll move back higher and take out prior pivot highs and we'll go higher. If not, we're going to come back down and test this again here. And then if it's not a valid break, we'll probably move back below, do a retest, and then work our way back down again. So this pattern right here is all predicated on us taking out 1940 next week. Now, this week was a option expiry week. So typically price action Wednesday, Thursday, Friday tends to be a grind higher. And in our case, we had a big move up on Monday, Tuesday, Wednesday, just huge moves. And then we're just digesting this move as I showed you in this pattern here. So that's kind of what I'm looking at. Now, the other side of the coin is, because a lot of people want to know, gee, has the bottom been made down in this area here? Because if, and let me erase this here for to try it again. You can see we made a low there, but then we made a lower low there, and then a slightly lower low there. So every time we work our way back down again, we're making lower lows. So if we do not or cannot penetrate this area, notice this red line here is the 50 EMA. We came right up to it, and then we just bounced hard off on Thursday and Friday, and then kind of settled in just a little bit on Friday's close, or going into Friday's close. But if we can't penetrate this area and we have a pullback here, I suspect we'll have another attempt at that area. But if it fails, then the odds favors to come down and challenge this area right here. Now, if I take a step back, this green line here is a pullback area. It's not an official node. The first official Fibonacci node is 0.38. But I use this a lot because it's a very, very reliable pullback zone, 0.236, on very strong bull moves. And you can say we've had a very strong bullish move over the past 4 or 5 years. If I come back in here and let's just step it out to a weekly, and let me get the screen back up here for you guys. You can see here what I've got indicated here on this weekly chart. And looking at this area here, it's still on a weekly chart. Longer term, I think the odds do favor a little bit of a rollover. You can see there is no bullish divergence here on the weekly chart. I would have loved to have seen here a low and this low here, or a lower low, and then given us a bullish divergence up in that area here. That would mean longer term, the odds favor the strength of the markets to take us back up here. But because there is no bullish divergence, any move up here, even all the way up to this area right here, is suspect, and the favored action going out to this weekly chart is a rollover here. All we are in right now is a little bit of a bounce back to the upside. Now, and let me just clear this off again, and I'll put another little drawing on the chart here. You can see this rounded top as we move up, and then I round it out like that. Okay, so we could get a little bit of chop and then work our way back up into that area, which is right around the 2000 zone, and then we'll make another attempt, and then next thing you know, we're right back down here again like this. And should this break, the official bear market territory for the E-minis is right around the 1704, 1705 area. That gives us a 20% downdraft from these peaks that were made in the summer of 2015. So, if we break this area here, which is a very strong support area for the markets in a strong bull market, if we break it and we come down here, then we're going to be down into a bearish market territory of 20% down. Now, we can have a bearish market even if we're not in a recession. We've got a secular bull market, but we could have a cyclical bear market as we try and work our way through. And then, of course, if I step out a little bit further and show you the bad side of this, let me just bounce it out a little bit more. I'll get the screen back up here for you. And we move it out even more. You can see here that this huge extension off these prior pivot highs here on this, looking at this weekly chart. That was 2007. This was the dot-com bubble back there. And you can see that should we take that out, and then we hit the bearish market territory right in that area there, right around the 1702, 1704 area. So it's a psychological barrier. And then boom, if we break that, there's going to be a lot of panic selling, which could even take us back down to this 1573, 74 area. And extending that line over, you can see that it would be a, well, I didn't draw a very straight line now, did I? But you can see that it measures the topping action that we made in 2000 and 2007. So guys, this is a very believable number, and very realistic. And we've got this huge downdraft, this move up, this downdraft here. We may make another wider attempt at it back up here, but the odds do favor us rolling back over again. That would carry us into the summer months of 2016, into the August-September timeframe. So just be very careful of this bounce that we're getting. Be very careful. Even if we run up over 2000, 2080, be very careful. The only thing that would change my mind is on this weekly chart, if we can have a start to make higher lows and higher pivot highs, and we get consistent in that. And as long as we don't take out prior pivot lows, then we're okay. But we're nowhere near that right now, everybody. We're nowhere near that. And the other thing that kind of goes along with this, and let me get the chart back up here for you guys. The only thing that also goes along with is look at the fear trade. If we look at the bond market, and we look at what's going on in the bond market, this is the weekly chart of bonds. Get it back on the screen for you guys. If we look at this, we moved right up and hit my target here, right around 170, 26 ticks. Boom, we hit it, and we're setting up for a bearish divergence. So, and if I take it down to a daily chart here, you can see how we moved right up into my zone here. And this does suggest that we may come back and test it again. But I would be more apt right in this area here, because I still think we have some more upside momentum for the equity markets, of possibly taking some shorts in the bond market, or going long TBT, or going short TBT, at least in the interim. But we've got to be very careful here. If we look at the 10-year interest rates right here on the chart, and get it up for you guys, you can see here just how low we are on the 10-year interest rates, right? And let's just back it out. We actually went lower than we did all of 2015. We've taken out these lows with this huge rollover right here that was made back in February of this month, and now we're working our way back down again. Just really amazing here. How low these rates are. Folks, that shows people are pouring into U.S. Treasuries. We still got issues in Japan, China, Europe, and pick your poison. You can pick your headline number, but either way, you just watch price action. It'll tell you how it's interpreting the headline numbers. But the headline numbers aren't that necessarily that good. And we've also moved to negative interest rates, which is scaring the children. Japan just did it. It followed up with Sweden, Switzerland, and Denmark. They're all in negative interest rate area, trying to reduce the strength of their currency. It's a race to the bottom. China has got the yuan pegged to the U.S. dollar, but there's talk of them trying to unseat that, or depreciate the yuan a little bit more. And meanwhile, we're the country here where we've stopped our stimulus, and the feds are on record as saying that they're looking at doing interest rate hikes next year. Although going into this week, we had Bullard come out in a press conference, or in a presentation after markets closed, I think on Wednesday or Thursday of this past week, saying that they don't see a rate hike, or he does not see a rate hike coming in March, which is the first Fed meeting since December or January. So let's look and see how this thing plays itself out. But look at gold on this daily chart here. Let me just get it back up. You can see here This was the opening price in January, right here, right around 1061. And boom, we made fresh highs, and we're just off to a very strong start. I can expect a little bit of a pullback, but I think gold, as long as there's fear in the market right now, it's more a fear gauge than an inflation gauge. Although we did have some signs of inflation and wage growth on our CPI data here in US on Friday. So we've got a lot of danger out in this market right now. And then the other major commodity that everybody seems to be following right now, we've made some good trades in it, by the way, is in oil. We've called some lows in oil. You can see all these pivot points, these colored bars down here. I've called these lows, and we've hit them right down to the T. And now we've got this bullish divergence here. So we could see a little bit of a bounce in oil, but I don't think it's going to last. I think that oil is going to come back over again until they start to work the inventory levels out and the excess supply out. But I do believe we're trying to form this low here in oil. And let's see how things work themselves out. So net, everybody, I think the momentum could carry us a little bit higher, but be very careful on the indexes. And I'm spending more time right now, as I told our members, on the index, because when you have higher volatility like this, um, that the markets tend to have a higher correlation, meaning what rolls over, you have an 8-to-1, sometimes 9-to-1 ratio of stocks down to stocks up. So, we're seeing that. And then one final thing, I'll leave it with you for the weekend, is if we look at the VIX, you can see here in the VIX in my color-coded chart here. Well, let's get it back on the screen for you. You can see here we're we moved just slightly into the top level of zone 2. These zones here represent volatility levels that, for each zone movement, we generally tend to use different option strategies and trade strategies based on what zone that we're in. And right now we're kind of on the border, just slightly below zone 3, but we're still elevated in volatility. The VIX closed Friday at 2053. Now, given that big move up that we've had this past week and this big bounce, normally you would see volatility a lot lower than this. But, what we've seen here is volatility maintaining these elevated levels up in the higher part of zone 2 and certainly up in zone 3. We've been up here going all the way back to the beginning of January. Volatility's not giving it up just yet. That tells me that the markets are still concerned about what we're looking at out of March and April timeframe. So again, until we can get volatility settling back in the lower part of zone 2, maybe even to the higher end of zone 1, then I think things will kind of clear out a little bit. But right now, this is a really great environment for option traders. We've got a lot of premium out there, so we need to take advantage of it. All right, everybody, for our members for this Sunday evening, I'm going to be at the New York Traders Expo, meeting and greeting and having a lot of fun. So our Sunday night weekly market watch will not be on. We will pick our session back up Tuesday morning. If you're not a member of our user group, I highly encourage you to come in and join us. We're having a great kickoff to the year, and we're having, last year was a good year for us, so there's no reason to believe with the good start we've had this year that we shouldn't continue on. Have a great weekend, everybody, and I'll be in touch. Bye now.